This is the Empowering Healthy Business Podcast, and I'm your host, Cal Wilder. Each episode, we'll dive into topics important to folks who want to run businesses that are both nicely profitable, sustainable, and scalable, and who want to achieve balance in their lives and realize their potential inside and outside of work. This show is sponsored by SmartBooks, provider of bookkeeping and accounting for businesses. Let's get started. Welcome. Today is our third episode in a series introducing the financial operating system, and it's the 10th overall episode of the podcast, so it's a minor milestone, a nice round number. I certainly have a lot more great topics to cover in future episodes, but it's fitting that today's episode is number 10 because the topic for today is one of my favorite topics in finance. A couple episodes ago, we introduced step one of the financial operating system, which is defining the why that you're in business. Then in step two, we define the what you currently have when we assess your current finances. And now today, in step three, we're going to introduce financial performance metrics, which really are the where that you are going. And a good set of metrics also gets into the how you're going to achieve your financial objectives. They help operationalize financial performance. They bridge the gap between operations and finance, and they start to explain the how you go about achieving your desired financial results. And our approach is first to focus on the metrics, and then second to set goals for each metric. And so the difference is, for example, if I've got a business with a cash flow problem, and I think collecting from customers is the primary cause of my cash flow trouble, then I need a metric around collections. And so on a weekly basis, my metric might be what's the percent of delinquent customers that we called this week? Or on a monthly basis, it might be what is the days sales outstanding at the end of the month? So, those are the metrics. Now, the goals might be I want 100% of my delinquent customers called each week, or I might want a day sales outstanding or a DSO of 35 days at the end of the month. But the key is, get the metric right, and then we can incrementally improve performance over time and upgrade our performance standards over time. So listeners, you may be familiar with the concept of SMART goals, S-M-A-R-T. So those would be, specific. So it's very tangibly defined. It's measurable, so we know how to measure and whether we're achieving it or not. It's attainable, so it's realistic. It's something we could actually do. It's relevant because it's closely aligned with our financial objectives as a company. And it's timely, meaning we have, a defined period of time in which we need to achieve a certain level of performance. So we want to keep the SMART concept in mind as we set goals. So let's talk through a real world example of setting a SMART metric and SMART goal. So you might have a goal or an objective of growing your business. So that's definitely not SMART as that is defined, but here are some of the ways we could make it smarter, right? So what constitutes a successful growth rate? Is 5% annual growth a win, or is that a loss if we could actually be growing the business 20%? All right, so, trying to grow the business, well, what constitutes a successful growth rate? Let's say we're trying to grow the business 20% per year. Well, what exactly are we trying to grow 20%? Are we trying to grow revenue by 20%? Customer count by 20%? Monthly recurring revenue by 20%? We measure, run rate at the end of December. Are we going to do year-over-year reported numbers under GAAP accounting, right? So we got to get very clear on what is the specific goal that we're trying to achieve, because that will define operational requirements to go implement whatever SOP and efforts we need in order to try to achieve that goal. Let's say the business has been growing 10% a year, and now we set a 20% growth rate. How is doubling achievable, right? The A in SMART. Is it really achievable to grow twice as fast next year as the previous years? What's going to change to allow you to do that, right? Are we adding a VP of sales? Are we investing more in marketing? Are we targeting a specific vertical we've had a lot of success in? What's going to be different next year than last year to make a much higher goal attainable, right? If our goal is to, if the financial objective of the business owner is to maximize profitability, to save money for retirement and fund their kids' college education, well, goals based around growth aren't necessarily as relevant to financial objectives. So we want to make sure that, if we're trying to grow 20%, is that really aligned with putting more profit in the pockets of the owner? Or maybe we should just try to grow 5 or 10%, but really focus our goals on more relevant metrics around profitability. And then finally, to grow the business 20%, we're going to need to execute over all 4 quarters of the year, all 12 months of the year. We're going to need to set some cascading goals for Q1 and Q2, Q3, Q4 that all roll up into our 20% annual growth. But we've got to get the year off to a good start. We can't assume that we're going to pick it up in July and August in order to hit our annual growth goal. We've got to, pick it up consistently over the whole course of the year with some timely metrics for each quarter and month of the year. So sometimes metrics are set to focus attention on solving a problem, like collections on the previous example. And then sometimes metrics are set more on long-term strategic goals of the business around growth and profitability and targeting a certain industry vertical or something like that, right? Trying to execute on a 3 or 5 or 10-year vision. So both are perfectly valid reasons to set an important company metric and get it on the scorecard. If the problem is big enough, then it's fine to create a metric to solve that problem. But let's try to remember that once we've solved that problem, if collections is the problem, once we're doing regular collections calls to customers and we've got our DSO down to a reasonable number, we can replace that metric with something that's going to be a little bit more impactful. Some questions I get around goals, and eventually we're going to dig into specific metrics and goals, but some of the questions I get around metrics and goals include, over what period of time should I set these goals? And so my perspective on that, after working with a lot of businesses over the years, including my own businesses, is that goals that are set based on more than 3 years into the future are really more in the vision territory, kind of big picture, here's where we're trying to go, than in specific goals that we're going to measure and manage toward when we show up to work every day. Now, some folks may operate perfectly well with 5 or 10-year plans, a lot of detail, and look, more power to them. That's how I used to think. I used to be one of those people that loved to have 5, 10-year goals and, showed up to work and had all these cascading metrics for what I needed to do this week that was going to translate into achieving a 10-year goal. But that's hard for most people to get their heads around. And eventually became hard for me as well, because once you get beyond 3 years, we're kind of guessing and hoping we're going in the right direction. Once we get less than 3 years, then we can have some very specific metrics that we can really wrap our arms around. We can really cascade down to, this year, this quarter, this month, and what do I need to do this week, right? Beyond that, it's a little bit hard. And so there's some frameworks that can help organize our goals and help provide a common language. Some of those goals, some of those frameworks include the Entrepreneurial Operating System, or EOS. There's a great book that came out probably in the 2010 kind of time frame called Traction, which introduced the concept. There have been some other books published by the author Gino Wickman following up on that. But EOS is a very structured framework geared around defining weekly scorecards and quarterly rocks and annual goals and tackling issues in a systematic way. It's a great framework. I've used it. Clients have used it. The only knock on EOS is it sometimes gives a little short shrift to strategy and making the decisions that differentiate your business from the competition that's going to allow you to win with your target customers. So EOS is great for execution. You just got to remember, if we're working on EOS, make sure that we have a differentiated strategy that's going to allow us to win in our chosen marketplace. OKR stands for Objectives and Key Results. It's another common framework in place. I think it got a lot of attention when a book was published called Measure What Matters by venture capitalist John Doerr, who invested in all the big name multi-decabillionaire companies like Google, etc. And so that's geared around defining objectives that we're trying to accomplish, and then 2, 3, 4 measures of how well we've advanced toward that objective. And so you might have an objective to increase revenue 20% if we keep working on that one. And then the key results that we're trying to achieve might be, bringing in 15 new clients in a certain industry vertical, generating a certain number of inbound leads from online marketing, things like that. So we can come up with 3, 4, maybe even 5 key results that would support growing the business by 20% and really manage toward those key results that drive us toward the objective. And then the other framework I'll mention is called Scaling Up. It used to be called Gazelles. And that one is very strategic in nature, about finding that one thing that's going to allow you to grow the business by 10x. And so for businesses that think strategy is going to be the key to their ability to scale dramatically, Gazelles could be a great framework. Sometimes it gives a little short shrift to operational execution, kind of the inverse of EOS. But whatever framework we use, make up your own. 2 things are critical, though. Number one, there's got to be a shared vocabulary and shared definitions that everybody understands. We want the energy of everybody in the company going into achieving goals, not negotiating what they mean or how they are measured, right? So we want to make sure it's very clear, the vocabulary and the definitions of the goals. And then the second thing that's critical is we want to have alignment between departments and teams within the company. We cannot have goals that conflict with each other, or be like a rowboat with rowers rowing in opposite directions, right? We don't want to have a sales team purely measured based on, new logos sold to new customers, while we have a fulfillment team focused on gross profit margin, where sales might be willing to discount the heck out of deals in order to hit their growth target for net new logos. Meanwhile, the fulfillment organization is inheriting all these discounts that completely conflict with their gross profit margin target. And we might have a customer service department that's measured on customer or client retention, and very focused on how do we retain these clients. And so if they don't have the ability to offer any discounts or service credits, they may feel like they're handicapped in the ability to hit their own metrics. So it's important that we give a lot of thought to, once the organization gets to a certain size, making sure that the metrics align between the departments and teams and the overall company metrics. To use an analogy back to that rowboat, if we have like one rower on that boat who's out of sync with the rest of the rowers, it kills the entire boat. If you just picture it, one guy's rowing backwards when everybody else is rowing forward, knocking into oars, it completely kills the effectiveness of the team. So sometimes it's just one metric for one department that's out of line that can derail the momentum of the entire business. So another question I get is around, achievement rate expectations. What should I expect as the business owner for achievement of goals, right? Is 100% the standard? I expect to achieve every goal. Or is 75% good enough because we've set a goal sufficiently high that getting 75% of the way there, 80% of the way there is great. And there's really no right answer, but the key is we've got to be clear and consistent about what that standard is. I personally like somewhere around 80% because I feel like if we set an expectation that we're going to achieve 100% of our goals, then we may not set ambitious enough goals that we can really realize our potential as a company. Because we're going to set some ambitious goals, and when we get most of the way there, but not 100% of the way there, and we want to be able to celebrate that as a win and not view it as a loss if we come up a hair short of an ambitious goal. However, I think if the expectation, is less than achieving 75 to 80% of goals, then we may just not take it seriously enough. So that's the risk of setting a target that's too low. We want everybody working like heck to achieve those goals. And if we can hit 80% of them, then that's a big win. So if we have 4 or 5 goals, then achieving, all but one of them is okay. Or if we have an objectives and key results framework, the OKR framework, we may have an objective and then 3, 4, 5 key results. So if we hit, all but one of those key results, then that's a win in the OKR framework. So we can set these metrics, and then we're going to get to specific metrics, but going through kind of the structure and the framework before we dig into specific metrics. And so once we define some metrics, we start populating them into a scorecard. And scorecard's that's a topic for a whole other episode in itself, and we'll cover that. But how we organize and structure scorecards is key. So we just cover a few brief concepts now, and then tune into a future episode where we'll drill into a lot of detail on scorecards. But briefly, we've got to have a weekly scorecard that rolls up into quarterly and annual goals. We need weekly accountability. If it's not clear what people are supposed to be prioritizing and accomplishing every week, they create their own priorities and they lose track of what we've defined as most important for the business. So we've got to keep people on track with weekly scorecard accountabilities. And the weekly metrics tend to be activity-based, effort-based, standards-based, where there's an expectation of, we have defined a standard for what good performance looks like at this company, and the expectation is we achieve 100% of those standards just by showing up, caring, working hard, and applying our skill. We can achieve 100% of our standards. Now, there's a difference between goals and standards, and this is very important. There's a great consulting organization called The Program that first laid out really clearly for me the difference between goals and standards. So goals are objectives that we're trying to accomplish to create long-term big wins for the company. However, if we fail to achieve a goal this quarter or this year, we can reattack it next quarter or next year, right? Maybe we came up a little bit short. Maybe there's some things that weren't fully under our control. Maybe something bad happened to our industry, something bad happened to our economy, something bad happened in the country that year. And so we were not able to achieve the goal. However, along the way, we continued to execute on our standards. We did our marketing and sales activities every week. We did our customer service activities. We maintained high quality of whatever we delivered to our customers. We did the best we could under the circumstances, but we came up short of the goal, and we'll attack it again next quarter or next year. And so a lot of the weekly metrics tend to be leading indicators, meaning, they're activity-based and they will result in the financial results that we want over time. So a leading indicator might be those collection calls, it might be marketing activities, it might be number of sales proposals presented. These are all things that do not equal revenue dollars or profit dollars, but they are the activities that, when done consistently at enough volume, will produce the revenue and produce the profit and produce the cash flow over time. If we do the required weekly activities and meet our standards on a weekly basis, then we are likely going to achieve our quarterly goals. The quarterly goals are going to be more lagging indicators. Quarterly goals might be revenue dollars. They might be adding a certain number of new clients, right? We can't show up for work this week and, book $1 million of revenue and 10 new clients. What we can show up is we can reach out to our 10 existing clients to do some quality assurance work and nurture the relationship. We can make 10 calls to prospective clients in our target vertical. We can contact every client who's delinquent in payment. There are things we can do this week that will roll up and put us in a position to hit our quarterly and annual goals. But our weekly metrics tend to be activity and standards based that roll up to quarterly goals and annual goals that aren't as purely under our control and that are more results-based lagging indicators. So important to keep that in mind as we set metrics and design scorecards. All right, so let's talk about some specific metrics. So I divide metrics into a few different categories, and these are determined, the mix between these categories is dependent upon the why you're in business and the business model. So things from step number 1 of the financial operating system, where we define, what we're trying to accomplish financially from owning this business. What's our basic business model? Okay, given those two facts, then let's figure out the set of most meaningful metrics. So there's a temptation to include everything, right? Every metric seems like it's important, but some are more important than others. Common question I get is, how many metrics should we have on our scorecard? So, my answer is typically no more than 10. 5 would be better than 10. Individuals can only focus on so many metrics. So if I have to show up to work today and worry about achieving 10 different metrics, that's going to spread me pretty thin to try to keep all 10 top of mind. But if I show up to work and I only have 5 that I have to worry about, or 2 or 3 even, then I'm going to be more laser focused on making sure I achieve those smaller number of objectives. Now, caveat this with the fact that, in small businesses that do not have different departments, the company scorecard could end up being bigger because it effectively combines department level metrics into one report. Now, larger businesses, they have a top level scorecard that may be distilled down into a shorter list if there are separate department level scorecards. So if we had a finance department scorecard, collection calls would be on there, cash in the bank or some kind of cash metric would be in there, a number of other things. Those are not all going to make it into the top level company scorecard. But when the CEO sits down with the CFO and goes through the finance department metrics, they're going to be covered. And then the top 1 or 2 may make their way onto the top level company scorecard. And the same thing with, the marketing department, the sales department, customer service department. They're all going to have their own scorecard. So if each department has 5 things that are really critical, but you're a small business and you don't actually have 5 different departments and people are in multiple seats, we may end up with a company scorecard that has 15 metrics on it. And that's okay. Eventually, when your business grows and you have multiple departments, then we can break it out into department level scorecards. So as we go about creating the list of metrics that really matter most, a few things to keep in mind. So if we've got a great set of metrics, it's going to provide an accurate picture for how the business is performing and what's driving that performance. It's going to balance those short-term leading indicators that are more activity-based against the longer-term lagging indicators that are more results-based, right? A great set of metrics will make it very clear to every role within the company what they're accountable for and how it rolls up into the overall company's objectives. And it's going to provide feedback on a regular basis about how we're performing against our job missions, right? Now, there's some shortfall or pitfalls that we want to avoid with metrics as well. And so we want to avoid the wrong metrics. That sounds obvious, but, got to mention it, because if we've gone through the trouble of defining our why, what are our financial objectives in owning this business, we want to make sure we have metrics that support that objective, right? So if we're really trying to maximize profitability so the owner can fund his retirement account and pay for his kid's college education, then we've got to have metrics around profitability. All our metrics around, producing leads and selling new deals without any regard to profitability of those deals, then we may be at odds with the objectives of the owner and have the wrong set of metrics. We might end up with too many metrics. And as I mentioned a couple minutes ago, people can really only focus on 5 to 10 metrics. Fewer is better. Real estate on scorecards is really valuable. It's precious. If we have too many metrics, people can drown in those metrics, or they'll just cherry pick and focus on the metrics that they are most comfortable with or most easy for them to hit, and ignore the ones that are harder or that might even be more valuable for the business. We talked about alignment and cascading of metrics. We want to make sure that the metrics do not conflict with each other, and we want to make sure they're not incomplete, right? And so we might think that improving customer retention is a really good metric, and improving profitability is a really good metric. However, if we have a group or segment of customers that are with us because we're giving them discounted pricing that's not really profitable, now we have a conflict. We've got a metric around improving or maximizing customer retention, and we have an offsetting metric around improving profitability. And so we can't retain unprofitable customers and achieve both of those metrics. And so we need to carefully consider what the priorities of the business are. And again, coming back to the why we're in business, what is most important to ownership, and ensure we don't have conflicts within our metrics. And then the other thing to keep in mind is making sure the people who are assigned responsibility for metrics have the ability to manage and drive those metrics. So C-level executives have power to drive profitability through policy and spending and pricing decisions that they make. Frontline customer service people don't typically have that level of power over making policy decisions, but they can provide a great client experience. They can quality control the work. They can reduce the defect rate. They can reduce the return rate. There are things that they can do that support the overall mission of the company to be a nicely profitable business. But the metrics for people who work in a warehouse or in customer service need to be geared toward things they can actually control and do themselves. All right, so let's talk about, actually, we're getting at the point of the podcast, we're going to talk about actual metrics here. So a few categories, as I mentioned. So we have some sales metrics. So these relate to things that are going to add new customers, add more revenue, grow the business. So growth-oriented businesses are going to have more sales type metrics within their overall scorecard. And so we have metrics that can reflect the different stages of the sales process, from marketing activities to generate leads, to new meetings with prospective clients by salespeople, to presenting sales proposals, to closing business and the close rate. All those things that reflect the different stages of the sales process in the pipeline. And those are really important for businesses that are growth-oriented or that are project-based, that need to replace their revenue every month, every quarter, every year as old projects finish up. And so the book goes into a lot of detail. There's tables and tables of metrics in the book. So I'm not going to highlight each of them. That's what the book is for. But there's definitely a very important category of metrics around sales. Then once we have customers, we move into what I call the customer value metrics, where we are assessing how happy customers are, how long they remain a customer, what's the lifespan of the client. When they're a customer, what's their net promoter score? How happy are they? What's the price they're willing to pay compared to the cost of fulfilling their orders? So that can be our, labor value multiple, customer level labor value multiple reflects, the value that we're delivering to the clients. Critical metric to have a long-term viable business. Then we get into our profit metrics. So we go down the income statement. We can look at gross profit margin, contribution margin, customer acquisition cost, the ratio of our average customer acquisition cost to the average lifetime value of the customer as measured by contribution margin of the customer, right? And we get back to keep going down to general and administrative expense, labor value multiple for G&A staff, so how much contribution margin and gross profit is our overhead supporting. I mean, that's the purpose of overhead, is to support gross margin and contribution margin. So we want to hold them accountable. They're running a lean and mean operation to support as much gross margin and contribution margin as possible. When we get into our cash flow metrics, so ultimately we want to be converting sales into dollars of cash in the bank. And there are a number of ways we can tackle this. If we have collections problems, we definitely need a cash flow metric on our scorecard. So it could be, on the short-term activity-based scorecard, it could be collecting advanced deposits from customers. It could be making weekly collection calls, those kinds of things. Longer term, we could be looking at days sales outstanding. We could be looking at, if it's a company business model that has inventory, we could be looking at inventory turnover to see how quickly we can sell inventory compared to the value of cash we have invested in inventory. We've got our nice accrual basis, nice, clean, great accounting accrual basis income statement. We want to know how much of that reported profit on the income statement we actually converted into operating cash flow going into the bank. To reduce the stress and aggravation of worrying about how much cash we have in the bank. Can we make payroll? Who can we afford to pay this week? We might need to set a metric around how many months worth of operating expenses do we have in cash in the bank. So what's our multiple there? We want to get that multiple north of 1, because when it gets too far south of 1, we spend a lot of unproductive time trying to manage who we're going to pay, who we can afford to pay, taking collection calls ourselves from vendors. We spend a lot of time on low value activities. Instead of growing the business, making our business better, we spend a lot of time worrying about cash flow. So we want to make sure we've got a profitable business model with enough cash reserve in the bank that we don't have to worry about cash flow from week to week. And then the final category of metrics would be capital investment metrics. So these would be relevant for businesses that have a lot of cash invested in property, plant, equipment, real estate. So we want to know what's the return we're getting on those assets. What's the return on equity? The return on the net worth of the business. And what access to liquidity do we have in order to fund additional equipment purchases? And so these are really important. And at a certain point for businesses with a lot of cash investment requirements, the return on invested capital is often more important than specific profit margin percentages on the income statement. It's more about, we've invested a lot of cash in this business. What are we getting for a return on that cash? There's some businesses out there that can generate tremendous returns on invested capital, even though if you look at the income statement, the margin's very low. Like a company like a Costco or Walmart, for example, when I last looked at them, they had relatively low profit margin percentages, definitely single digit, if not low single digit, but they were turning over their inventory so quickly they were able to generate tremendous returns on equity. So those are kind of the categories of metrics. I want to highlight 4 specific metrics, and again, refer you to the book for the more comprehensive list of common financial performance metrics. But I'm going to highlight 4 right now that tend to be very important. So one of them is contribution margin. And so contribution margin is really gross profit minus the service cost of delivering those services or producing those products. And so it's a measure of value on one hand and cost efficiency on the other hand, right? If we've got a low contribution margin, it might be because we're pricing our products too low, because either we're not appreciating how valuable they are in the marketplace, or we're competing in a commoditized marketplace where the customers will only pay so much and we just can't price high enough. And so we're stuck with low margins because, our product or service just isn't that valuable. And it's a reflection of cost efficiency. We could be charging a very high price for that product or service, and the market could perceive it to be worth a high price, but we might have a low contribution margin if we're very inefficient in how we deliver the product. So it's really balancing, the value in the marketplace that customers are willing to pay in terms of the price and your cost structure to deliver that service. The second metric is lifetime customer value, and we measure that in terms of contribution margin. Now, sales guys will love to talk about, the lifetime revenue of a customer. But revenue doesn't pay the bills. Contribution margin ultimately pays the bills and produces profit to owners. Revenue is important, don't get me wrong, but without contribution margin, we don't have money to pay that salesperson to bring in the customer, or pay the overhead and rent and insurance, or have any profit left over for owners. So we really want to focus on contribution margin, which is the measure of the lifetime value of a customer. How many dollars of contribution margin are we going to get from our average customer over their lifetime as a customer? So it's a formula. It's average customer lifespan in number of years times the revenue per year for that customer times the contribution margin percentage. And that'll tell us what our lifetime contribution margin for the customer is. And that's really important. We want to know what that is, and then we can measure the return on investment from our marketing and sales activities, where we can compare our lifetime customer value against our cost of customer acquisition, right? So if we know we're going to get, on average, $100,000 of lifetime contribution margin from a customer, that will inform how much we can afford to spend to market and sell and sign up that customer, right? So if we can spend $10,000 to acquire $100,000 of lifetime contribution margin, that's a pretty nice return on investment. Or, we're beating our heads against the wall, we're spending $100,000 on expensive marketing people and efforts and online marketing and a sales team, and on average it costs us $100,000 to bring in one customer who's only producing $100,000 of lifetime contribution margin, then we are losing money. We've got a business model problem that we need to solve. And that brings us to our fourth metric, which is customer retention. And so when we talk about lifetime customer value, we need to know the number of years that we have the customer. And so if we express this in percentage terms, if we are willing to accept losing 1% of our customers per month, to use round numbers, that means we're going to lose 12% of our customers per year, or we're going to retain 88% of our customers. So our annual customer retention rate can be 88%. That's pretty good. But we need to be careful about the compounding effect of small numbers, right? Because we have a monthly scorecard. The difference between 0.5% and 1% and 1.5% seems pretty small. I mean, it's only 0.5% or 1% difference. But if we have 0.5% monthly churn, that's going to get us 6% annual churn, use round numbers, and that's going to be 94% annual retention. And so that's going to get us a significantly longer lifespan than if we had, 1 or 1.5% monthly churn, which would mean we'd only retain 88% or 82% of our clients each year. And so the difference in average client lifespan is quite large there. It can have a major impact on the profitability of the business. There are math exercises we can go through to illustrate all that, but remember to focus on, what's the long-term number of years you expect to have the client and work backwards to a reasonable monthly customer retention metric, and make sure that it rolls up and cascades in alignment. And so that's it. Hope you've enjoyed this introduction to financial performance metrics. The key is really, if you don't have a set of metrics that you're using and managing around, something is usually better than nothing. Create the best set of metrics that you can as your first set of metrics, and then you follow it, you iterate, you improve it over time. You replace a metric here and there with something else that may become more impactful for your business. Now, if you want some help creating metrics for your business and tracking them, feel free to reach out to me. You may likely find, if this is your first time implementing and managing metrics, that you may need to upgrade some of your accounting operations in order to accurately report on some of those metrics. And so the next episode of the podcast will discuss some of the common areas in the bookkeeping and accounting function that small business owners need to upgrade. And so between now and the next episode, I'd encourage you to put together a set of your best set of financial performance metrics, 5 to 10 great metrics that really align your business operations with your financial objectives as business owners. Start using them, start iterating, start improving them over time. But, there's no time like the present to get started managing toward the numbers if you haven't done that yet.
Another episode in the books. Thank you so much for tuning in. For show notes and more, visit empoweringhealthybusiness.com. If you would like to have a one-on-one discussion with me or possibly engage SmartBooks to help with your business, you can reach me at C-A-L, at empoweringhealthybusiness.com or message me on LinkedIn where I am easy to find. Until next time, this is Empowering Healthy Business, the podcast for business owners, signing off.